Some investors prefer income to capital gains. They prefer that regular income coming in, in forms of interest, in forms of dividend, in form of coupon, and they tend to de-emphasize capital gains or capital appreciation. And so, in this video, I want to talk about the basics of income-oriented investing. Income-oriented investing is a strategy for reliable income. This strategy typically employs the concept of seeking steady cash flow, such as people like retirees. They look for steady and regular income. So this particular strategy would actually fit their needs. I want to highlight the key concepts of income investing. It starts with the definition as well as the purpose, and I would like to give us a definition of income investing. It's an investment approach that aims at generating regular income through interest, in forms of dividends or even cash distribution from your investments. And so the aim actually is to provide steady stream of income while preserving your capital. Is often suitable for those who need predictable cash flow, to cover living expenses and other financial goals. People like retirees, they will appreciate this kind of investing. Number 3 is types of income-oriented investing. Types of income-oriented investing. A typical example here is dividend stocks. Shares in companies that regularly pay out dividends to shareholders. High dividend yield stocks. That are considered dividend aristocrats. They provide regular income. They provide consistent income to their shareholders. You also have another example is bonds. Bonds are debt instruments or fixed income instruments that pay periodic returns and to investors, while at the same time the investor could get the principal amount at maturity. These include government bonds, municipal bonds, as well as some corporate bonds. Government bonds are issued by the government. Municipal bonds are issued by the local government or by municipalities, whereas some corporate bonds are issued by corporations, by companies listed in the market. Another example is real estate investment trust REITs. Real estate investment trust, these are companies that own, operate or finance income-producing real estates. REITs typically pay higher dividends, from the rental income they generate from the real estate they rent out. So the income, and the returns they obtain are paid out to their shareholders. Another typical example is certificate of deposits. Certificate of deposits. This is a kind of fixed term deposit offered by banks that pay a fixed interest rate, over a predetermined period. It's like a fixed deposit. When you're putting your money there, after a predetermined period, after a fixed period, you get your interest as well as your money back. You equally have preferred stocks. Preferred stocks actually, these are like a kind of hybrid securities that pay fixed dividends and they have priority over, common stockholders. When it comes to dividend payment, when it comes to liquidation also, uh, preferred stockholders get paid first, and whatever remains goes to the common stockholders. That's why common shareholders are the core, risk bearer of a typical company or companies. You have annuities. Annuities actually, these are insurance products that provides guaranteed periodic payments for a set term or for life. You know, it's often used to provide to provide income at retirement, provide retirement income. You have the last one here is income mutual funds, and exchange traded funds that they invest in a diversified portfolio of income generating assets such as dividend stocks, bonds, and ETFs. So these collective investment, these unit trusts, these mutual funds and ETFs, they invest in income generating assets. That's their core investment approach. So we want to highlight the benefits of income-oriented investing, the advantages. So in this case, you have steady income stream. They provide regular cash flow, to their investors to meet their living expenses or to reinvest in the case of dividend reinvestment strategy. You equally have capital preservation. So in this case, you discover that many income-oriented investments, such as bonds, a certificate of deposits, guarantees that your capital is preserved. You get your initial investment back as well as the income it generates. You equally have diversification. So it helps you to diversify from traditional investment approach by investing in different asset classes. And by so doing, you tend to mitigate your overall portfolio risk. So I want to consider number 4, the pitfalls, disadvantages, the drawbacks of income-oriented investing. Number 1 is lower growth potential. There is that lower growth because the emphasis of this kind of strategy is on income rather than capital appreciation. So it comes to be expected that you will not obtain, a relatively high growth, from this kind of investing because capital appreciation is not in the equation, compared to growth-oriented investments. Number 2 is interest rate risk. Bond prices and other fixed income investments tend to have an inverse relationship with interest rate. When interest rate is high, then of course, bond coupon will decline, and when interest rate is low, bond coupon will tend to rise. And not only that, you have inflation risk. Fixed income payments may lose purchasing power as a result of prevailing rates of inflation in the economy. So the dividend obtained, the returns obtained, the interest rate obtained may not be able to keep up with inflation. So you equally have credit risk. For bonds and other debt securities, there is a risk of default. The issuer may not be able to pay the expected either dividends or coupons, as the case may be. And they may not even be able to repay the principal. In some cases, the company may go bankrupt and may not be able to repay the principal, let alone the coupon. So in that case, the company gets liquidated, and shareholders or bondholders will then be paid their money Whatever remains will now go to the common shareholders.